Welcome to the Flow Tao Salon. The World Federation of Chinese Catering Industry and Black Valley Capital have released the 2025 China Coffee Industry Report, detailing a significant structural shift in the global and domestic markets. The global sector faces a supply crunch from climate change and new green regulations, pushing futures to a 47-year high. Simultaneously, China's 218 billion RMB market is moving beyond the era of simple expansion, characterized by a transition toward local capital partnerships. This convergence of upstream supply shocks and downstream market maturation is creating a complex environment where long-term profitability depends on supply chain control rather than retail footprint alone. This map illustrates the high geographic concentration of coffee production. 5 regions control over 70% of the global yield, with Brazil and Vietnam alone accounting for 52% of world output. Current production data shows a notable split. A drought in Brazil has led to a 4.7% drop in Arabica yields, while Robusta production is projected to grow by nearly 11%. This climate volatility, paired with European Union deforestation regulations, has increased compliance costs, pushing iced coffee futures to a 47-year high. Because large trade monopolies control the majority of global exports, downstream brands are responding with defensive risk mitigation strategies, including long-term supply contracts and the construction of their own processing facilities. China's freshly brewed coffee market exceeds 188 billion RMB, maintaining 20% annual growth. This is driven by a specific demographic: 62% female, 60% office workers. The most active segment is female professionals aged 26 to 30. This consumer base supported Luckin Coffee's expansion to 30,000 stores, establishing it as the global leader for store count within a single market. With basic market penetration largely complete, the competition has shifted. Maintaining margins in this environment now requires extreme operational efficiency and integrated supply chains. This M&A table highlights Keurig's $18 billion acquisition of JDE Peet's. In China, local partnerships dominate. Starbucks yielded its majority stake to Boyu Capital, while Blue Bottle and Costa negotiate with local investors. This move toward local holding models suggests that domestic expertise is becoming a primary strategic asset for foreign brands. Consequently, investment interest is pivoting toward B-end smart equipment, AI yield prediction, and automation. The report concludes with 3 primary findings. First, supply chain stability and green compliance have joined price strategy as essential pillars for brand survival. Second, the partnership model with local capital has become the predominant strategy for foreign brands navigating the Chinese market. Third, future growth opportunities are shifting away from the saturated retail market and into B-end robotics and AI roasting technology. Tao Zui Shalong, Ma Nian Xinglong. Scan the code to download the complete industry report.